In this video, we're going to talk about the top 10 ways to invest in stocks. Before starting, do like the video and subscribe to the channel for future updates. Stock investing can be a successful long-term strategy for wealth accumulation. However, it can be challenging to know where to begin given the wide range of investment options available. We'll discuss each strategy benefits and drawbacks as well as the dangers and potential rewards. Number 10, day trading. In day trading, an investor buys and sells stocks or other securities during a single trading day with the intention of profiting from swift price changes. In order to find companies with strong momentum or the potential for rapid price changes, day traders generally utilize technical analysis. They may also leverage to increase their returns. Number 9, penny stocks. Penny stocks are shares of tiny, comparatively unheard of businesses that trade at low prices, frequently around $5 per share. These stocks are frequently traded on over-the-counter OTC marketplaces or on smaller exchanges since they are typically issued by tiny, financially constrained enterprises. Number 8, options trading. Purchasing and selling contracts that grant the holder the right but not the duty to purchase or sell an underlying asset such as a stock or an index at a certain price and time constitutes options trading, a sort of investing. These agreements are referred to as options, and there are two varieties, calls and puts. Number 7, direct stock purchase plans, DSPPS. Some publicly traded companies offer direct stock purchase plans, DSPPS, which enable investors to buy shares of their stock directly from the company without the use of a broker or middleman. The majority of the time, DSPPS are provided as an alternative to conventional brokerage accounts, which could incur fees or have a minimum investment requirement. Investors can regularly buy shares of a specific company's stock through a DSPP, frequently with lower costs and a no minimum investment restriction. Number 6, robo-advisors. Clients can receive automated investment advice and portfolio management services from robo-advisors, which are digital investing platforms that employ algorithms and software. They are often created to offer a simple, affordable substitute for conventional human financial counselors. Investors are often asked to complete an online questionnaire by robo-advisors to determine their investing objectives, risk tolerance, and time horizon. Based on this information, the advisor will then suggest a diversified portfolio of inexpensive mutual funds or EFTs. Number 5, dividend reinvestment plans, DRIPs. Some publicly traded companies offer dividend reinvestment plans, DRIPs, which enable shareholders to automatically reinvest their dividends into additional shares of the company's stock. By compounding dividends and enabling investors to buy more shares without paying any additional fees or commissions, DRIPs are intended to help investors increase their investment over time. The investor's dividend is automatically reinvested in the company's stock, usually at a discounted price, as opposed to getting a cash dividend payout. Number 4, mutual funds. Mutual funds are financial instruments that combine the capital of many participants to buy a portfolio of assets, including stocks, bonds, and other securities. An experienced fund manager is in charge of choosing and overseeing the investments made within each mutual fund. Number 3, exchange-traded funds, ETFs. Investment funds known as exchange-traded funds, ETFs, are investment funds known as exchange-traded funds, ETFs, are exchanged on stock exchanges just like individual stocks. ETFs are made to mimic the performance of a certain index like the S&P 500 or NASDAQ, or a particular industry like technology or energy, in that they pool funds from numerous participants to buy a diverse portfolio of assets. ETFs are comparable to buy a diverse portfolio of assets. ETFs are comparable to mutual funds. However, mutual funds are often actively managed by a qualified portfolio manager, whereas ETFs are typically meant to replicate a certain index or benchmark. Number 2, index funds. A sort of mutual fund or exchange-traded fund ETF called an index fund follows a particular market index like the S&P 500 or the Dow Jones Industrial Average. Index funds are made to give investors inexpensive access to a diverse range of assets. They don't need as much active management as other types of funds because they are made to match an index, which can lead to lower fees and costs. Number 1, individual stocks. Buying stock in a particular firm is a part of investing in individual stocks. Investors who purchase stock in a corporation are deemed shareholders and are entitled to a share of the firm's assets and profits. Stock picking can be a high-risk, high-reward method for investors. The performance of the firm itself can be influenced by a wide range of factors, including market circumstances, competition, and management actions, determines the outcome of a particular stock investment. So what'd you think of this video? Do let us know in the comment box below. Also like the video and subscribe to our channel for our future updates.